So as Andrew kindly said, I'm Kath Chapman. I'm from Ameresco. You already heard from one of my colleagues earlier on, but we're very firmly based on this side of the water. So I'm going to try and take you through a little bit about risk management and the options that we have for going forward and what we ought to be considering within those options. So if we look at the options that we have available for moving sort of forward to a low carbon future, most people these days have a flexible framework in place. Most large users now have often a green framework in place, but they have a 3-year flexible framework in place with a supplier which enables them to purchase. And therefore they do a variety of different things. They will do some hedging, so you will be buying forward. You might do that in seasons, quarters, etc., but you will be buying forward. They may well have some bespoke arrangements, some longer term type arrangements with suppliers, and they may well leave an element to float on the market. So they may have the risk appetite that means that some of their buying is done perhaps on the day ahead market or shorter month periods. But they have these frameworks in place that enable them to manage their power purchasing. Okay, so how do you get from this situation to where you want to be, which is a low zero carbon world, and how do you manage your risk within that? Okay, well, there is going to be an element of decarbonisation through the grid, and we've got a carbon forum later on today which is going to talk about how the grid itself will be decarbonising. There is always a place for energy efficiency, and we've talked this morning about that as well. So energy efficiency will have its place and will help drive you towards your low carbon future and also drive down the cost base. There will also be an element of renewables, so on-site generation continues to be attractive, particularly in power because of the avoidance of the third-party charges. And then another way of getting to that end position is through power purchase agreements, because power purchase agreements are zero carbon reporting because they meet the DEFRA additionality requirements. So all of these things should be part of your route to controlling your costs and getting towards that low zero carbon goal as we move over the next 5 to 6 years. So if we take a look at modelling forward prices, typically what we would have done is we would look at the oil price and look at where the oil price is going over the next 5-6 years. We'd then look at the gas forward curve, which goes out further than the power forward curve, and at the far end we can use the the oil price to estimate what the gas price would be. We would have the electricity forward curve, and we would therefore use oil and the gas forward curves to price what the electricity forward curve is out at that far end of the market where there isn't a liquid electricity market. But what we're starting to see is a decoupling of the electricity and gas market further out. So once you start getting out towards 2022, whilst the trend is the same, you'll see that there's a wider variance that we're starting to see. And this is as more renewable comes onto the network. And if you look at the German market, for example, you do see a strong decoupling at certain times of gas and electricity prices because of the high level of renewables that they have on their network. So what this means going forward is perhaps for the later years, once we get past 2021, we should be starting to look at the electricity trend within its own right, rather than just within the gas market. So I'm not going to go into a lot of detail now about the prices. You're going to get headline prices for each year, rather than the detail that the gentleman before managed to go through. But let's just look at what have been the major drivers over the last 5-6 years on prices. And hopefully this will work. So yes, we have Japan and the Fukushima event, which pushed the need for gas up. Then we started to see gas price demand come down. We saw shale coming out of the US in 2015, and the US reduced its imports. 2016, we were in a gas oversupply situation with mild weather, and we saw the price crash. In 2017, we start to see the prices recover. We see the Trump impact and the Brexit impact. And then we've started to see, as we've seen, a turning point. So we had a very bullish market in 2018, and now we're starting to see a turning point and prices come back down. So Yes, so how do we manage volatility and what does normal look like? So if we look back since 2014 and look at what the price has done, this is the range of prices that we had. So if we take this range of prices and we were out at September 17 and we say, okay, from this point, where do we think prices are going to go and what range are those wholesale power prices going to be? And we can adopt all sorts of sophisticated modelling techniques like looking at the standard deviation, looking at the movements between each day's price, each month's price, to try to predict what range we think those prices will fall into moving forward over the next 2-3 years. And if you'd done that back in 2017, you'd have ended up with an upper and lower range that looks like this. So that would have said, okay, we think prices are going to be between 30 and 55. It's still a massive range, but that's what you would have ended up with. What did prices actually do? They actually did that. So they broke that upper range. And all that that's really trying to say is there is so much volatility in our markets, it makes it very hard to predict what those wholesale prices are going to be going forward. I think the previous presentation sort of very well illustrated all the factors that influence, gas prices and electricity prices. And to try to predict all of those factors, is an extremely difficult job to do. And that's why something like a PPA can start to reduce the volatility that we're having to live with within our markets. And I think the previous presentation as well demonstrated very well that that volatility isn't going to go away. If anything, it's likely to increase, which makes decision making very difficult for energy buyers. But if we look at PPAs, PPAs are generally structured in a way that you have a strike price and then you have an indexation. That indexation may be RPI, CPI, it may be a fixed number, but what that effectively is doing is reducing the amount of risk that sits within your power purchasing portfolio. Because say you buy a 50% proportion or 25% proportion, what you're doing is de-risking that element from the energy market volatility, because it's no longer indexed to energy market prices. So for a portfolio, for a large portfolio, you can de-risk down from, say, a 10 million swing to a 3 million swing. And that's why they have their place in terms of managing your overall risk portfolio. Mm-hmm. So what are the key points to take away? Low carbon. We obviously we need to create a portfolio of options to enable to get ourselves to the low carbon future that we're all striving to get to. They need to include energy efficiency. They need to include on-site generation. They need to include PPA options or other longer-term structured options, because that's where you can reach your goals. The prospect for prices to 2025, we do have downward-facing forward curves, and we are going to see the impact of renewables coming onto that network. The expectation is that's from 2021 onwards. And obviously we have the very low short-run marginal costs associated with renewables, so we would expect to see that in. Flexibility and risk management. We would love markets to always get it right, but sometimes they get it wrong. But what that gives you actually is an opportunity. So if you have the longer frameworks in place, then you can take opportunity from that, because that actually gives you the ability to pick up bargains. And finally, the use of PPAs. You can use them strategically because they are a very useful tool to reduce volatility. As I say, we've seen all the different factors that drive the market, most of which are outside of our control within this room. So therefore the PPAs are a useful tool that you can use to reduce volatility. And that's it.
Okay, thank you very much. Right, coming to the seats. Kath, when you talk to your clients, and I talk to my members, there seems to be almost two groups emerge. There are those who actually have a risk management policy.
Yes.
It's sometimes linked with the corporate risk policy.
Yes.
And there are those like poor Stuart Reid from Fair Plastic this morning, if you heard him, who has no policy. Sorry?
Great opportunity.
Great opportunity, Angus. You're not getting tired of Thames Water, are you? Yeah, let's ask a couple of our stalwarts. Michael, you've followed this for a long time in Ibstock, haven't you? You've very much got a risk policy, haven't you?
I have, yeah. For us, from an energy point of view, we think it will be better or even worse off after Brexit.
Yes, that's coming this afternoon. Yeah, oh, bless you. That's a spontaneous question this afternoon, Michael. Yeah, no, but in terms of Ibstock, obviously energy is a huge cost for you.
It's the second biggest cost of business.
Yeah.
I think you'd be looking at
Yeah,
is how do we de-grid in our business.
yeah,
The big issue we have is if you take our energy mix, it's made up of 8% electricity usage, 92% gas. In terms of costs, it's 37% of costs,
yeah,
8% of usage.
yeah. So you're looking at a risk policy for gas primarily.
For gas is the main thing. But the biggest
Right.
problem is, as well as £4 million of our money is spent in electricity for green taxes.
Yes,
So we don't get the investment because of that.
Yeah.
One can-
yes. I want to bring in our suppliers over here. Let's start with Ørsted. I mean, you're going green and are green.
Sure.
And when you interact with your customers,
Yep.
do you find most of them have a risk management policy?
I would say that whether you be on a PPA, like a fixed priced agreement, or whether you're on a spot, even being on a spot is a policy. It is a strategy. So as a trader, if I'm taking everything to spot, I'm bearish the market, I have a view, I have a position. So if you, this talk of having a strategy or not, if you are on spot, that is your default strategy.
And it used to be said that that was the cheapest way of buying it because you weren't pricing in any risk.
But that was always our policy for at least 15 years, 20 years. 4 out of 5 years we gain more than you would lose on spot. At the end of last year, we took a decision for the first time in our history to buy longer. We're now buying 2021.
2021.
We tend to try to implement what we call a good value policy. So if a price represents good value, and we do that through modelling what the cost of a new power station would be and what the marginal running cost of that power station would be. If you're at those sorts of levels, you're at what is a fundamentally good price. So we tend to put that message out because it's one that's relatively straightforward for people to understand. Am I at good value and therefore should I be buying wherever it is along the curve, whether it's a month out, 6 months or 5 years out? Do those prices represent an attractive level, both historically and in terms of the cost of the assets and running the assets? And that can give you a good value strategy, which we find works quite successfully because it will work in a variety of different markets. So,
I would just want to jump in on that, though. As any risk manager, we will offer this kind of view, this kind of approach. But the question always comes back to us when the market drops like this, how come we were doing this when I could have done better on spot? Expectations are very important. View is very important. Price versus budget is extremely important. You have to decide the type of outcomes you want to see for yourselves and create a strategy either with one of us, with a consultancy, and then you will find that you won't have to do this versus spot, versus forward. We can make a lot of comparisons. And most consultants, most energy providers can always find a point in time where you would have done much worse, and a customer can obviously point to us and show us where they would have done much better.
Yeah, of course.
So what is it that you want to achieve? That's the most important thing I do with customers is have the discussion. What is it you want to achieve? How much budget certainty do you want? How long is your horizon?
Well,
if
that's
it's
the key,
1 month
isn't it?
or 1 year or 5 years.
Yeah, let's get Nick in on the act here. Nick, market risk and commercial lead.
Sure.
Does that mean that you're buying the gas for Corona, or is this for you're advising Corona's customers?
I'll describe sort of where I fit within the
Yeah.
organisation.
Please.
I'm sort of second in charge of a team of 10, and we're across trading, risk management, procurement, and pricing. I sort of look after the market-facing side of the team, and I have a colleague who looks after the pricing side of the team. And what that entails is our parent company is Macquarie Bank, so we do most of our market access volume, physical volume through the bank. And our business model is traditional fixed price supply, but also the vast majority of our portfolio is flexible procurement in gas, predominantly to I&C customers, major corporates, etc. So we look after hedging the risk around our fixed book, but also helping some of our key gas clients understand their wholesale market exposure. And one thing I found really interesting just in that little conversation there is Jade made the point that it really comes down to what you as consumers, as buyers, are trying to achieve. The feedback that we get quite often when we present that idea is that a lot of people don't actually know what they're trying to achieve. And what I think Jade said there, that was really important, and something that is key to take away there is timeframes. It's really, really easy to trade in hindsight, where you can point to a point in time where you say, we should have locked out there, we shouldn't have locked out, etc. It's really easy to focus on performance in the short term or in a specific period. But when you're running a business that has obviously such a major part of your cost base is your energy, you need to be looking at the longer term as well. And one of the, I look back to 2016 as a prime example of this. There are parties who had hedged their positions quite far in advance and ended up paying well over the prompt prices, particularly through summer 16, winter 16. And a few of them felt that they had missed out. When in fact what had actually happened was when you dug a little bit deeper, because they had in place longer term strategies, which meant that they were not just focusing on prompt, they were focusing on the front season, front year, 2-3 years out, even some of them. They actually benefited further out on the curve. They didn't necessarily win in that very short term, but across the next 2 years, they actually beat what they would have done had they left positions open for longer.
Okay. Joe, you've done quite a lot of work on pricing predictions, haven't you?
Yes, I'd love to say I'm the absolute expert, but I sit next to our risk expert every day, and he makes me look like a moron a lot of the time. But what I can kind of glean is because I kind of sit in between, so I'm seeing these kind of risk algorithms, these predictions on market, where it's going. Obviously, I've gleaned a lot of stuff, what's been said about volatility and how that actually affects your modelling. And I kind of sit between, as I say, like the guys actually writing the algorithms and the end users. And for me, when it's kind of mentioned about flexibility and risk management, I automatically think of your modelling. How are you even using a risk management model like kind of Monte Carlo is something that you may or may not have heard of, and how that's kind of reacting to the volatility of the market we've just seen. Is it actually overreacting? Is it giving you far too much of a spread on the kind of the fan, as it were, of where prices may go? And what I could try and impart is something that we've learned because we've been working with the University of Kent and their finance department. And we're basically finding that you do need a flexibility in the actual model that you're using. So depending on what the market's doing at any point, you maybe want to be looking at kind of Monte Carlo simulation, but actually combining that with variance, covariance and filtered historical simulation, so you can try and narrow that gap down because obviously the biggest risk to anything, whether it's the commodity or non-commodity, it's the unknown. If you're not sure what's coming, if you're not sure where price is going to be and you're looking at a ridiculously wide spectrum, that's, to me, the biggest risk. So hopefully if I can impart anything, it's basically have flexibility in the modelling you're using. Don't just think, I've got Monte Carlo, I'm okay. Check that model, make sure you are kind of building it as kind of in depth and building in parameters to be able to look at it.
Right, so hopefully that stimulated some thoughts from the floor. Gentlemen, yes, it's...
It's David from BT.
Yes, it is David. Hello, David.
A question for Kappa, I guess, the group there. You mentioned the marginal cost of building new generation as a useful kind of benchmark. A, I'd be interested in what you think that is right now, and B, also whether it's been volatile over the last 12 months of the market
No, it doesn't. I mean, it's something that we've developed and we review sort of once a quarter, if you like, but it's not something that you fundamentally change because it's about a long-term asset investment decision as opposed to sort of, where the day-ahead prices or the year-ahead prices. The one thing that did fundamentally change it was the change to the carbon market, because we did actually see that as a market structure change as opposed to a short-term volatility. So that change to the carbon market effectively, we think, is added £5 a megawatt onto the wholesale price of electricity. And yes, the carbon market moves around as well, but that was a fundamental market change that occurred from January this year. So that was something that did affect what we saw as long-term good value. But yeah, we do provide sort of quite simple, and we look at it in gas as well, so that we've got a benchmark against which to always be looking at forward prices. And you can use that same benchmark, because it's not something that's volatile, to look at prices over a multi-year period. So it doesn't just work for 2019. You're saying that's the cost of a new asset and what the cost of, what are the short and long-term marginal costs of running that asset. And that doesn't really vary that much over multiple years. So therefore it gives you a long-term horizon over which to make decisions. Because the one thing I always say to people is, if a price looks attractive, say it's at £45 a megawatt hour, people say, I'm not going to buy that. I say, well, in that case, you're 100% certain that period price is going to drop by not taking that decision. But when we sort of see prices at around those levels, we would say that they're attractive prices. And that's another reason for sort of looking at PPAs at this time, because we're seeing them as being in the money in terms of, the strike prices.
Well, there's two questions here. Can we take the lady first, Andrew?
Yeah.
Joy?
Lady first.
Hey.
One comment from me, Joy Vickers from Energy Mind by way of process under that. One of the things that, having come from an end user background,
Yes.
always concerned me was when we talk about the things that you can, to a degree, have really good, robust risk management policies or not, if you're kind of flying by the seat of your pants a little bit. There's always been around consumption. I think, just to accept year on year increases in consumption is not okay.
Yeah.
And actually, do you know what? What are we doing as organisations, and actually what are we doing as suppliers and consultants? We all have to be invested moving forward on how we reduce consumption. And the reality is, as much as you've got a good flexible procurement policy in place and good contracting to allow you to do sell backs and put in the efficiencies and things, just accepting year on year to just use more is a massive risk. So I think, as an open question to all of you,
Yeah.
in terms of what you're doing to support your customers, and then what we're doing to do what we can, we're doing the best we can from that side. How that works.
It has to form part of that goal, doesn't it? Which is why it was in the energy efficiency and sort of supporting customers reduce their consumption has to be part of your overall strategy. Is key.
Yes, good point. I'll bring these gentlemen in here, because when I thought of the thing, I'm thinking about risk in its broader sense over a longer period of time. We're not looking at the short term, we're looking at the next 5 years out, and we're going to be debating that after lunch. And so this does bring in, as David was saying, should I be investing more in my own generation? Should I be doing more energy efficiency? Should I be buying a PPA? And it's that kind of risk policy that I believe that we should start to embrace as we try and manage forward for 4 or 5 years, not just the next 2 years.
But the critical thing for me is, having spent a little bit of time doing this, is having it underpinned by really good, robust contracts, as well as risk management policies, to allow you the flexibility to, if you decide to actually, bring in some amazing schemes and so on and so forth to reduce, actually, you don't want to be overhedged either. So ultimately, it's making sure if you've already hedged and you've done so much work so far and ahead, that's all well and good, but actually, it's looking at the whole holistic picture.
Looking holistically at the whole thing.
Yes, people think of risk management as just, do I buy on the day ahead or do I buy a month? But it isn't. It's a package of all of it, because that's actually the way you manage your risk.
So let's bring Andrew in here.
Andrew Smith of Pneumatic. In terms of the people in the room, we're a minnow in energy consumption.
Well, I don't think so.
We're about
You're very
10
modest.
gig of electricity and the same for gas. I briefly spoke to someone, probably at this event last year, about PPA, and I was told, no, you don't use enough. Somebody else since then has said, oh yeah, you can talk about PPA with a relatively small consumption like that. What is there a threshold for PPA?
We typically do see a threshold. It has come down. It's the same as flexible purchasing. When flexible purchasing first came out, it was sort of 25 gigs and above. And we've seen that come down to as low as 5 gigs for flexible purchasing. Yeah. Yeah. And before, people used to have to sort of go into a basket to get access to those types of contracts. That isn't the case anymore. I mean, I think being realistic, it would be quite difficult to get a PPA away under sort of like a megawatt level. So it would depend on your load and what it looked like. But if you had a flat load, then potentially you could. It would depend on your base load requirement, to be honest.
Electricity is very stable.
Right.
Gas, of course, is so much dependent on weather.
Yeah. But yeah. So it would depend on your load factor.
So, Jade, you've gone through a sort of pretty much a metamorphosis, haven't you? I mean, years ago we used to have Dong natural gas here, and now, of course, Ørsted is going totally green.
Yep.
And in this journey, are you encouraging and are you helping your members? I think this is the point that Joy was making, to look at the whole situation, and it's not just a question of the buying of it; it's the planning of it forward for the next several years.
Yeah. To Joy's comments, we do this in a few ways, and our primary speaker has touched upon this. By having a longer-term approach to risk management, we stabilize prices in a narrow band over time, which frees up resources for investment. So that's one thing. That's one way about this. A lot of customers I talk to are very interested in making investments, but especially when it comes to power, we're looking at 70-80% of the cost of your power is just taxes, schemes, and so on and so forth, and it's not the commodity. So even if we can help you a lot, power side, I'm speaking of right now, a lot of that is call your MP and ask them why you're paying so much. On the gas side, there's a bit more flexibility on that. There are a few more opportunities. I did actually want to speak to what you were saying. What we are seeing with regards to PPAs and size is that we are moving from big customers, PPAs, smaller customers, PPAs, groups of customers, basket PPAs, and competition in this area is going to intensify. The more renewables that are input into the system, the more companies will want to work with buyers to get them on PPAs. I'm not going to say yes, all PPA, no market. I'm a trader, so I'm interested in financial solutions to these kinds of problems. A PPA is one, as is trading the forward market. But for you in this situation right now, most trading operations can offer you some type of synthetic look-alike to what a PPA would be for your volume. So if stabilizing the price is what you're looking for, that's a possibility now without having to get into the PPA market if no one will underwrite you because of your size. So there are always options. A trader's answer to everything is always yes. Then we figure out what it's going to cost you. But the answer is always yes.
And is the answer yes at the end of the table there, Joe? I mean, my idea of this is how do our members move smoothly and without undue risk into what has been a carbon-dominated market with the last 50 years with the gas, as John and I know, and what comes in the future, which is the low-carbon market. It's the bridge across, isn't it?
Yeah.
I mean,
I think the answer in terms of is it a good time, and obviously the million-dollar question is what is a good price, which has already been asked at the forum earlier. But obviously that's what, if you're making those decisions on PPA or when to buy or anything to do with the financial side, it is basically understanding your delivered cost. So again, and from my point of view, and other people might disagree, but you've got to be modelling that. You've got to be saying to yourself, what is my delivered cost going to be in 2022, 2025, whatever it might be. If you're not sure on that, you really need to put some work into it because it's going to affect the decisions you make on PPA, on trading decisions you might be making now. I'm no expert on PPA whatsoever, but I think it still comes back to that fundamental question, what is a good price and what's it going to be in 2, 3, 4, 5 years, and actually make an educated decision that's kind of auditable so that if anyone asked you, why on earth did you do that? And obviously Michael's mentioned about your change in your risk strategy. You get a huge pat on the back and a massive pay rise, I'm sure, with the kind of the how well that's performed for you. But you need to be able to answer to the board, why did I make this decision? If you can categorically say, at that time, this was what the information I had, therefore I've made this decision to go down the PPA route or to change my strategy, then I don't think that you would have a problem.
I want to bring my old friend John in here. Hello, John. 50 years since we started out on this route. Do you see, I mean, we've lived off 50 years of natural gas, you and me, and we've seen the demise of coal and heavy fuel oil and so on. Do you see the next 2 or 3 years as important in terms of moving to a low-carbon future, in terms of the market implications, as it was all those years ago when gas started to make a play?
Yeah, I think most certainly. I mean, what we've had, I mean, when you start looking at emissions, where we are today, we're back down to close to 1990 level, simply because of gas. In America, we heard going about Ameresco. I mean, in America, although President Trump's tried to sort of move them off the agenda, the climate change agenda, the states have rallied around, and actually because of gas, they've gone back down again. So gas is incredibly important. I mean, the one aspect about gas is that we always used to say it's half as dirty as coal.
Yeah.
People are now saying it's not quite half as dirty as coal, but the reality of it is, with abundant supplies of gas, which is where people are going to at the moment, it's making a hell of a difference. And I think that's the way it's going to go forward in the future. Wayne showed us earlier how the price has fallen away. LNG is moving around the world. I mean, LNG is coming from places that aren't quite always as friendly as we'd like them to be. But the reality of it is, gas is available, there's lots of it there, and assuming it comes to the UK and doesn't go straight off to Asia, I think we're on to a winner. Again, you've got the Nord Stream coming from Russia, which will help move supplies through. I don't think we actually buy gas directly from Russia, but it comes into Europe and filters its way through to us. But at the moment, you've got sort of China slowing down because of the trade wars. If China picked up big time, and they're looking at growth now, I think it's like 6 to 6.5%. If that pushes up to 7 or 8 and demand picks up for gas, it may tighten supply growth. But I think overall gas is certainly way ahead now, far more so than it has been in recent years.
Well, that's very good, because we're going to talk about that again this afternoon. I was almost encouraged to ask Dave today, when he was talking, he's with us in the audience, whether this wonderful new trade deal we're going to have with the US-UK is actually going to mop up some of your shale gas that you've got in the States, because it seems to be an obvious thing to do. But that's more for later. Final word from Kath. Any sort of final Angus, you want to say something?
Yeah, just moving on. I support your comments there. It's just about in risk management.
Final word.
It's going to be wrong, but you're providing a degree of cost certainty to the business within its risk appetite. Well, I'm interested moving further forward as the market is changing dramatically. The volatility is moving. Where we used to say that actually you'd be taking a percentage a month ahead than now, then it's day ahead, and now it's businesses are looking within day and within block. What's your views on risk management of within day and within block and market price? That's the reality is that if we're going to drive the low carbon agenda, intermittency is there. The price signal Ofgem has said it with the reform of the real-time market price. It's volatility is coming out of national grid products into the real-time market. So the risk management of that is either a risk to the supplier or a risk and an opportunity if it's pairing with the right partner in the customer. What's your guys' views on how that's going to work and the risk management technique?
Right, 10 seconds each, because it's lunchtime.
You want to go first?
Sure. I mean, there's so much to it. There are times you're going to be right, and there are times that you're going to be proven wrong. I think, actually, Dave, in his presentation this morning, hit on a really good point. We don't have all the answers. We have information at hand. And sorry, Dave, I am paraphrasing, but we don't have all the answers right now, but the answers will become apparent. What you need to do really is position yourself in such a way, with all the information that you have at hand, position yourself in such a way that you can benefit from what you think is the most likely sort of scenario once those answers do become available to you, but also limiting the risk that you're exposed to. And the sort of four key things that I sort of come back to is align your business objectives. Go away and think about what you want to achieve with your energy. Align that as closely as possible with your overall business objectives. Take a view on sort of what sort of timeframes you want to firm up. Refresh and review is the key. So what's an appropriate strategy for you now in terms of what you think may happen in the future and what your current positioning is? May not necessarily be appropriate in a year's time, 2 years' time, 5 years' time. And the other thing to think about is cross-optimization. So it's important not to become too focused on sort of one area that you're looking at, and take a holistic view and see if things went against you in one area, is there somewhere else where you would sort of cross-optimize?
Now, do you two gentlemen agree with
longer
that?
than 10
Are
seconds,
you
I
going
apologise.
to say yes, or do you have other things to add?
The only thing I'd add is there will always be winners and losers, and make sure if you want to be on the winner side, of course, digitisation, information, you can't just take these leaps without understanding what you're doing.
Make sure you join the MEUC benchmarking service, I think you said.
Volatility on spot is already high. The more we take base load out of the system and add renewables, the more volatility you're going to get on those intra-period blocks. So if you want to be exposed to them, you have, like in Germany, you will have zero prices, negative prices, and you will have €1,000 prices. So if you want that exposure, if that exposure is something that can be an asset or an advantage, then you should have a strategy around how you utilize it. If you don't want that kind of volatility, then you should have a different strategy. And all of us would be very happy to talk to you about those kinds of strategies. Thank you very much for your time.
Kath, who did the work producing the presentation, final word from you.
Yes, risk management strategy has to be akin to a business. We always say think of it as more like a financing strategy. You're going to use a number of different options and instruments to get you to the end position. And which options and instruments are right for your business depends on your business model, your time horizons. But it has to include sort of a multiple tactical approach. It's not just one way of doing it.